Dear investor, Edelweiss Private Wealth Management is pleased to present to you the latest issue of Investment Strategy Report for June 2021. Let's take a look at key highlights of May 2021. India's real GDP grew at the rate of 1.6% in the fourth quarter of financial year 21, while for the entire financial year 21, the economy shrunk by 7.3%. Government expenditure was the major contributor to the growth in fourth quarter of financial year 21. The fourth quarter of financial year 21 witnessed positive growth in all the sectors of economy for the first time in the last fiscal year. However, the lockdown which had to be imposed to counter the second wave of COVID since the beginning of current fiscal year has started to show its effect on consumer sentiments. The lockdowns have also caused employment scenario to worsen in the last couple of months after showing minor improvement in the last quarter of previous fiscal year. At the global level, fiscal stimulus provided by developed economies was much higher and quicker as compared to that by emerging economies. This, coupled with proactive planning and timely execution regarding vaccination, have enabled the developed economies to relax the lockdowns. Equity view. Indian equity markets continued their upward march without FII support in the last month. Mid-cap and small-cap stocks continue to outperform their large-cap counterparts. Fundamental elements like earnings growth and profitability, which were missing in the last 2 to 3 quarters, are expected to continue despite a probable blip in the first quarter of financial year 22. SIP contributions from domestic investors, especially into equity mutual funds, continue to remain strong. Sluggish private consumption and unemployment worries can act as headwinds to the performance of Indian equities going forward. However, encouraging corporate earnings, predictions of normal monsoons, and sustained vaccination drives indicate limited downside. We continue with marginal overweight call on equities. Mark-to-market gains can be booked to be reinvested at attractive levels in future. Fixed income view. Fiscal deficit for financial year 21 has seen a huge jump due to loss in tax revenue as well as increased government expenditure in the last quarter of financial year 21. Still, yields at longer end of the curve seem to have stabilized due to RBI interventions like GSEC acquisition program. As a result, the yield curve continued to flatten, though still it is much steeper than its long-term average. Though WPI inflation in April rose to above 10% due to low base effect, the CPI is still comfortably placed around RBI's long-term target for inflation. This prompted RBI to continue with their dovish stance. Investment opportunities in high-quality credit have significantly diminished. High-yield credit can be considered subject to appropriate due diligence. The credit spreads can be expected to cool off as systemic risks will decrease with recovery in economy. 10-year benchmark yields are being contained at around 6% despite heavy borrowing by government in financial year 21, thanks to RBI's proactive measures like GSAP. While spreads of both AAA and AA shot up in the last month, dislocation in spreads still persists in high-yield credit, which may be opportunistically used. Core allocation to high-quality credit with diversification across investable credit spectrum in yield-oriented HTM solutions is advisable.